Welcome back to the deep dive. Okay, so if you're invested in the market right now, chances are you're looking at your accounts.
And probably not loving what you see.
Exactly. You're seeing what analysts, politely call a portfolio drawdown.
Which is just a fancy way of saying you've lost some of the money you were celebrating like last month.
Right. And that temporary wave down after a really nice wave up, it doesn't feel temporary in the moment. It feels pretty painful.
That emotional friction is absolutely real. And that's why we're calling this deep dive a kind of financial therapy session.
I like so.
Our mission today, and this is all based on the research you sent over, isn't to look at market mechanics. It's to focus on the psychology, the psychological tips for navigating this dip.
Because that's the only thing you can actually control.
It's the only thing. And your reaction is what's going to determine your actual long-term profitability, not the market.
That distinction is everything. Okay, so your sources use this one central analogy to guide us through this emotional struggle, and I think we should just use it as our visual anchor.
We could do it.
The investor as a pilot navigating severe turbulence.
Perfect. And that takes us right to the first therapeutic insight, which is acceptance. Just accepting it.
Okay.
The single most calming thing you can do is really internalize that temporary drawdowns. And some of them can be severe. They're not a failure of your strategy. They're just an unavoidable, mandatory part of the journey.
You have zero control.
Zero. You have no control over when the turbulence hits.
The pilot analogy is just so good here because it immediately shows you how absurd our own panic can be. Think about a skilled pilot. They study the weather, they plot the safest course, they confirm the plane is structurally sound, but they know air pockets exist, they know turbulence is coming.
Right. And the sources ask us to play out this completely ridiculous scenario. Imagine this expert pilot hits a patch of turbulence. The plane is fine, the engines are running perfectly, the destination is clear in the GPS, but the air is just rough for 10 minutes, and the pilot screams,
No!
grabs a parachute, and just leaps out the nearest door.
That is insane. You would never do that. You just bailed on a perfectly sound piece of equipment that was designed to handle far worse just because you felt a little bump.
You missed the destination completely.
Yeah, you're gone.
And yet, that is the perfect picture of panic selling. You are effectively parachuting out of a high-quality business, a sound financial vehicle, just because the short-term air pressure changed and you got uncomfortable.
To really, normalize this feeling for everyone, we have to bring in the legend. The undisputed G-weight of investing.
Peter Lynch.
Peter Lynch. He ran the Magellan Fund, achieved this, absolutely massive 604% return over 13 years. He beat the S&P 500 by 3 times.
He's the benchmark.
He's the picture of success.
But the research gives us this brutal reality check. Lynch's incredible long-term compounding success was built directly on top of massive short-term pain.
Okay, let's hammer home these numbers because they are genuinely, I think, shocking, but also really reassuring.
They really are. So Lynch, the GH, endured drawdowns ranging from 27% all the way up to an astonishing 56%.
Wait, 56%?
56%. Think about that. Even the greatest investor in history watched more than half of his portfolio's value just temporarily evaporate on multiple occasions.
Wow, a 56% drop. I have to say, just hearing that happened to the best of the best makes me feel so much less alone in this.
It removes the guilt.
It totally does. If he saw drops that severe and still compounded wealth at nearly 29% a year, it doesn't just normalize the experience for you. It almost makes it a prerequisite.
It's a price of admission. It just resets your expectations completely. Turbulence isn't an anomaly. It's part of the ticket price.
So true.
So now that we've accepted the air pocket, we need to focus on what to look at when the screen is flashing red. Which brings us to the next tip. Understanding the difference between price and value.
This is a big one. Why do prices drop so severely in the short term, especially when the company itself hasn't reported bad news? It feels so random.
It feels random because a lot of it is. The research is very clear on this. Short-term prices are often completely divorced from long-term fundamentals. They're driven by external noise, technical moves, and just pure fear.
Can you break down that technical noise a little? The sources mention a few things that have nothing to do with the quality of the business itself.
For sure. So you've got things like market maker manipulation, where huge players move prices just to trigger stops. You have the rapid fire of high-frequency algorithmic trading.
Algos.
The algos, yeah. And they just make swings worse because they sell based on momentum, not fundamentals. And crucially, you have forced selling from leveraged accounts. Brokers just liquidating positions. They don't care if the business is good or bad.
So all of those drivers are technical and psychological. They have nothing to do with whether the company is, selling more stuff or making more money.
Precisely. The intelligent investor uses the intrinsic value of the business as their anchor, the temporary stock price. That's just Mr. Market's emotional opinion on a given Tuesday.
I love that. The sources used a great, really modern example with a name everyone knows, like Amazon. AMZN.
Yeah, that's a perfect one. Imagine Amazon stock sells off, say, 20 or 30% during a market panic.
Okay.
You look under the hood. Is the company still generating massive revenue? Yes. Are they still expanding their cloud services?
Yeah.
Is free cash flow growing? Yes. The business itself is perfectly fine. Its intrinsic value hasn't changed one bit.
I see the power of that anchor now. If, like the sources say, crazy Mr. Market decides to sell a perfectly healthy business at a 25% discount just because he's having a panic attack, you haven't actually lost anything.
It's a phantom number.
Just a number on a screen.
You only realize that loss if you decide to join Mr. Market in his little panic attack and sell your shares at that temporary mispriced low. The moment you sell, the phantom loss becomes permanent.
Okay, let's circle back to the pilot's flight plan because that's the perfect way to frame the third tip. Focusing on the long-term destination.
Right. The pilot doesn't freak out over turbulence because they know where they're going. They trust the coordinates they punched in before takeoff.
Investors need that same focus. We have to ignore the daily vibrations and focus intensely on where that portfolio will be in 3, 5, or 10 years. That's the compounding engine.
And if we're invested in truly high-quality businesses, the research gives us some, phenomenal specific targets that can serve as that mental destination.
So what are those long-term expectations? Give us the numbers.
All right. If you maintain your focus, your discipline, you should expect your portfolio to roughly double in value in about 3 years. That works out to a 24% annualized return, which is incredible.
Double in 3 years. Okay. And what if we extend that flight plan out a bit further to 5 years?
Over 5 years, you should still expect your portfolio to double, which is about 15% annualized. These numbers, they should just force you to stop looking at the daily noise and look at the power of time.
And then there's the one that makes any short-term drops seem, utterly irrelevant, the 10-year target. Lay that one out.
Over a decade, if your businesses perform as expected, you should anticipate your portfolio being anywhere from 4 times to 9 times more valuable than it is today.
4 to 9x.
4 to 9x. Once you internalize that destination, does a temporary 20% drop this month really matter? It's a footnote, just a tiny blip in the story.
Those numbers are amazing, but honestly, they can sound impossible when you're looking at a screen that says you're down 30% today. How does the research say we maintain faith in those long-term targets when our emotions are just screaming at us?
By using the drawdown as a gift. It's a reframe. When you focus on that 4 or 9x destination, the temporary dips shouldn't just stop bothering you. They should be seen as an opportunity.
A chance to buy more.
A chance to add more shares of those fantastic businesses at a discount, which actually gets you to that final goal faster. The turbulence, viewed correctly, just lowers your cost of fuel for the rest of the trip.
That reframing that's the key psychological shift right there. Okay, now we have to get into the trickiest trap of all. The one we set for ourselves.
Our own inner monologue.
Yes. Tip number 4, addressing the language trap.
This is so critical because your language is causative. Your words affect your thoughts dictate your emotions, and your emotions absolutely determine your actions.
You create your own anxiety.
You do.
Yeah.
If you use overly dramatic negative language, you're just pouring fuel on the fire.
We have to mock some of the market jargon we read every day. The sources say to explicitly avoid these terms in our own minds.
Oh, absolutely. Like bloodbath. Stop saying bloodbath.
My portfolio is bleeding.
I lost X $1,000 today. No, you didn't. These are catastrophic, dramatic terms that assume the loss is permanent, and they force you into a panic state.
Right. When you say, I lost money, you're framing it as a defeat that's already happened, which primes you to take action, to sell, to stop the so-called bleeding.
You haven't lost a thing until you click that sell button. You just own shares in a great company that is temporarily on sale. Change your language, and I promise you change your psychology.
And that flows perfectly into tip number 5, The regret trap.
Ah, the toxic whisper.
The whisper that says, if only I had sold before the drop, I could have bought back in lower.
That thought is mental poison. It's paralyzing. The sources are definitive on this. It is fundamentally impossible to consistently predict short-term price moves. No one can do it.
So by entertaining that fantasy that you should have sold yesterday, you're just wasting mental energy on something that's totally unattainable.
You're creating what I'd call prediction fatigue. If you constantly think, I should have sold, you'll start listening to every doom and gloom expert predicting the next drop. You'll sell every time stocks dip a little.
And the result of that is devastating.
It's the worst. You will never stay invested long enough to compound your wealth toward that 4 or 9x destination. You'll always be the pilot jumping out of the plane mid-flight.
Okay. We've got our mind right. We've avoided the language and regret traps.
Yeah.
So what we actually do. Tip number 6 lays out the 2 concrete strategies for handling the turbulence. The 2 paths, action or distraction.
Path A is for those who have dry powder, available cash to deploy. For this group, a correction is Christmas morning. This is your chance to invest more in those high-quality businesses you want to own.
But the sources warn heavily against trying to time the absolute bottom, right? That's just another form of that prediction fatigue.
It is. Since you can never predict how long a correction will last or how deep it will go, the only disciplined way to capitalize is to buy in small tranches, little chunks of money over a period of time.
You average in.
You average into the position. It's disciplined, robotic buying, not gambling on the market's mood today.
Okay, but what about, and I think this is the vast majority of investors, the ones who are already fully allocated, they don't have any more cash to deploy.
This is where the simple genius of Path B comes in, the strategy we are calling the Netflix solution.
And this is, I love this, it's a serious piece of financial advice wrapped up in a joke. What is the Netflix solution?
The strategy is effective, non-emotional, and profoundly serious. Ignore the temporary market price. Just ignore it.
That's it.
That's it. Since you can't buy the dip, watching the ticker will only generate anxiety, trigger the regret trap, and tempt you into selling.
So if you are fully allocated, you should literally go watch a movie on Netflix instead.
Right.
Or take a walk. Or read a book. Anything but watch the screen.
Literally anything that pulls your focus away from the blinking red numbers. The goal is to enforce profitable inaction. If you distract yourself, come back in a few weeks or months, the probability is extremely high that the market correction will have largely faded from your memory.
And the business just keeps compounding.
The business keeps compounding, the value persists, and your psychology stays sound. You survive the turbulence by simply staying in your seat.
That's a great summary of it.
So, to synthesize our little therapy session today, drawdowns are normal. Even Peter Lynch saw half his portfolio temporarily wiped out. So, control your negative language. Focus relentlessly on the underlying business value. Avoid the regret trap, and stick to your powerful long-term compounding destination.
And if we leave you with one final thought, let it be about the often overlooked power of doing absolutely nothing. If distracting yourself with entertainment, the Netflix solution, is a legitimate, profitable financial strategy, what does that tell us about the rest of our money management? It suggests that the biggest hurdle to wealth is almost always our own temptation to overthink and overreact. Maintain that focus on the compounding destination and just let the turbulence pass.
That's our deep dive for today.